session will start with the launch of Gold Focus, followed by a brief highlight. May I request Mr. Nikos Kavalis, Metals Focus, to come on stage, requesting also Mr. Albert Cheng, CEO SBMA, to come on stage, please. We'll launch the Gold Focus 2026 at APPMC. A round of applause for Metals Focus at this occasion. A launch of Gold Focus 2026. Thank you. And now I request Mr. Nikos Kavalis, who is the founder, co-founder and director Metals Focus. He's been with Metals Focus and before that with GFMS and Royal Bank of Scotland, over 25 years of experience. Nikos, over to you.
Thanks a lot, Vatsa, and thank you, Albert, and thanks to SBMA and Evento for hosting once again such a spectacular event. I know you've heard it a million times already that we started 9 years ago with barely over 350 people, and look at where the event has gone over the years, and I think it's testament to the hard work and excellent programming that, apart from me, excellent programming that the guys at SBMA and Evento can manage to pull together every year. I have just over 5 minutes to go through the key findings of our annual Gold Focus, but first of all, I would like to take a second to thank our sponsors for this report. Of course, in particular, Valcambi, who for yet another year have been sponsoring the front cover, but also all the other companies that have been supporting us. Without their support, this effort would not be possible. In the last 6 months, and in fact, the last 18 months, we've seen breakneck rallies in the gold price over certain periods, rallies that we haven't seen in a generation. And that's been underpinned by extremely strong investment demand and in spite of the lackluster performance of the jewelry market. There's been a lot of macroeconomic factors that have supported gold, fat tail risks, extreme uncertainty about the impact of tariffs. I mean, a lot of it centers around the unpredictable nature of the United States administration. Reflective of the strength of investor appetite towards the metal, we've seen ETF holdings or ETP holdings reach a new high by the end of 2025, if we turn to the, let's say, more traditional supply-demand fundamentals, the physical market, global supply, in spite of high prices, has had quite a muted response. And of course, it's not straightforward to bring on new mines just because the price went up by 10 or 20 or 50%. We have seen some response from the ASM sector, but mine production in general is quite difficult to ramp up. But what's been quite spectacular for us is the limited reaction of the recycling market to the price environment. If you consider that we've had year-on-year, in 2025, we had a year-on-year increase in the average price of over 40%. Seeing a less than 3% increase in global jewelry recycling is quite impressive. And if you compare it to what happened back in the 2009 to 2011 period, where we had an explosion of recycling, it's quite an interesting backdrop. And I think it's reflective of the fact that in most price elastic markets, most major recycling markets, consumers just don't want to get rid of their gold, given the uncertain environment that we're living in. Understandably, given the high price environment, demand took a bit of a hit, so it contracted quite significantly if we leave out ETFs. And this was mainly driven by jewelry consumption being hit really hard across all major markets, pretty much. And this is not a surprise. Typically, consumers have a fixed budget rather than an idea of how many grams they want to buy. And when they go out and spend money on jewelry, they're getting less volume for their money. With all that said, if you actually look at the amount of money that's been spent on jewelry, that's continued to go up. So it's really the grams that have come under pressure because of the price effect. And the positive flip side of that is that bar investment demand has actually been extremely strong. We saw very strong gains last year, and although the last couple of months, demand has been a bit weak. I mean, the year started also on a very positive note, and we expect the full year number to be quite healthy. Central bank net buying is softening, but if you look at the actual volumes and you compare them to historical norms, we're still seeing a central banking community that has showing a very strong appetite to add to its gold reserves. Now let's look at what's happened more recently and where we're going from here. Look, the Iran war and the impact on oil and the dollar have definitely been a headwind for gold prices and investor sentiment towards gold. I think the other factor that hasn't helped is there's been a few false starts, rumors and news coming out of resolution of the conflict. So investors tried to enter back into gold, and they got hit pretty hard when the rumors did not materialize. And I think the other key factor here is the dramatic change in U.S. interest policy rate expectations. So we went from the start of the year where the consensus was for a couple of cuts over the course of 2026 to, as you can see, this is now a week out. Has now become a bit out of date, but around last week, we were looking at 2 interest rate hikes before the end of the year. It's now moved to 1 and probably early next year, but you can still see the dramatic change in the way the world is seeing Fed policy. And that has definitely hit gold. Now, metals focus, we just don't buy that. We don't see, we've had the view, which for a while was wrong, that the war will end quickly. But finally, it looks like a resolution is at least for, as of midday in Asian hours, it looks like a resolution is happening sooner than later. So as long as Trump doesn't wake up and start talking about sending Iran back to the dark ages again, hopefully we're gonna see conditions change very soon. And even though inflation will not disappear overnight, we just don't see the levels of inflation. Core inflation is just over 3%. We just don't see the levels of inflation likely to trigger a rate hike. So we're probably expecting rates to stay flat for the next 6 months or so, and I think as we enter next year, we're probably looking at conditions shifting again towards cuts rather than hikes. And, leaving that to one side, all the other factors that have been underpinning gold over the last few years, the last couple of years, whether this is fat tail risks and extreme uncertainty on U.S. policy, and of course, concerns about the outlook of the U.S. dollar, the extreme levels of U.S. debt and sustained deficits in that country. I think all that remains in place, and with this in mind, we have to be bullish. Cool. And move on to the next part.